All right. I'd just like to start off by saying to thank Mr. Ray for coming on and giving us his time for this Q&A session. And I guess we could start it off if Hasib wants to go first with a question for Mr. Ray.
Sure, I guess, and to kind of just go into it. I'm not sure if you're familiar with the Tom Palley's asset-based reserve requirements proposal.
Yeah.
I'm just curious as to what your thoughts are on that. Just curious to hear your thoughts on that.
Yeah, I think that dates back 30, 40 years from the very beginning, when post-Keynesians were rediscovering what came to be called endogenous money. And there was some debate between or among Basel Moore, who's promoting horizontalism, and Tom and Bob Poland, who are trying to advance this thing they called the structuralist approach. And they think that somehow you could use reserves to constrain banks. But they thought that you should have reserves against the assets instead of against the liabilities. So rather than the way that in the US we do this, you would flip it over trying to control the asset side by linking those to reserves, rather than controlling the liability side, which is demand deposits, by linking those to reserves. I always thought the whole thing was nonsense. The central banks accommodate the demand for reserves, and they're always going to accommodate the demand for reserves. If you want to control banks, you don't do it through reserves. You do it through regulation of banks, and you mostly want to do that on the asset side through direct regulation over the quality of the assets they're buying, not the quantity. So, yeah, I'm familiar with it. Never impressed by it.
Okay, thank you.
I guess I could go next with my question. I was just wondering, a lot of MMTers talk about like monetary sovereignty, and I was wondering if you think that's desirable for every country. If every country should like try and attain monetary sovereignty.
Well, I think that you have to be realistic in what's attainable. To some degree, there might be economic constraints. Probably more importantly, there are political constraints on what is feasible. I think that currency sovereignty, that is, having your own currency, imposing taxes in your own currency, issuing debt, talking about the government, issuing debt only in its own currency, gives you more fiscal and monetary policy space than any other system. And let me just add, all of this implies also floating your currency, because if you peg your currency, even if you issue government debt in your own currency, you're promising to deliver foreign currency. So it's as if you've issued the debt in foreign currency. So you don't have sovereignty in our sense of the term. So I think that it gives you the most fiscal and monetary policy space, but that may come with especially political consequences, maybe economic consequences. So I wouldn't want to make the blanket statement that every country, including the poorest, weakest states in the world, ought to try to do this. But I think far more countries ought to do it. I think giving up your own currency sovereignty, as the many European nations did, was a pretty crazy idea. And we've seen the consequences of that. We have seen the consequences of fairly economically important countries, relatively bigger countries with bigger economies, with reasonably well-developed economies that have tried pegging their currencies to the US dollar, issuing debt in US dollars, including Mexico did that. This almost always turns out badly. So I think, yes, they should try to increase their domestic policy space by issuing their own currency and floating and avoiding issuing any dollar-denominated debt. So as a general rule, yes, but I'm not going to try to make the case that every single tiny country in the world ought to try this. Okay, I think that as we move from the richest countries, down the list to developing countries and to low-income developing countries, the problems that are faced are different, and they're very difficult problems. I think that when we look at some of the smaller Latin American countries, their biggest problems are not economic problems. Their biggest problems are political problems. Okay, and there's no easy solution to this. So just saying, well, if they would only issue their own currency and float, everything would be okay, is almost certainly wrong. They have huge political problems they probably have to solve first.
Thank you. That really helped. I think Tanish wanted to go next.
Yeah. Hi, Mr. Ray. My name is Tanish. So my question comes from watching one of your
mic is muted.
I guess, lectures, so to say.
Whoops. Yeah, you cut out for a second.
Yeah.
Sorry, can you hear me?
Yeah.
All right. Sorry, my internet's just a little bit laggy. All right, so you were working with the Capital as Power Foundation, if I remember correctly. You was on a press with Nietzsche, if you remember that time.
Oh, working with what?
Sorry, you were working with the Capital as Power group.
Oh, yes. Okay. Now, yeah, I don't quite remember the name, but yeah, that's familiar now.
Yeah. So while watching you there, I noticed one of the main things you were focusing on lessons from the history of money and how money has evolved over time. What's one important lesson, especially going into the future, that we should definitely take from how money has been issued in the past and how money can evolve into what we need it to be?
Well, I think the purpose for studying the history of money for us today is to try to understand the nature of money. And the history sheds some light on that. And what I mean is, so probably all of you had a basic econ class and you learned the barter story, that you had Robinson Crusoe and Friday, and they used to try to trade bananas for coconuts, and they hit on the idea of using seashells, and then gradually there was this evolution of money to the point that they used precious metal, and then they coined it, and then finally, eventually we get fiat money. But that whole story was developed to make you focus on a particular view of what the nature of money is, that money is a medium of exchange. And then that leads to the whole neoclassical framework to economics, which is that money really is not an important thing. Money is, they say, neutral, and our focus should be on the real stuff. Money is only interesting when it goes wrong. When does it go wrong? When the government provides too much of it. What happens? We get inflation. And if the the government prints too much, we can even get hyperinflation. So it's that whole framework, the whole neoclassical framework is based on this view of the nature of money. When we study the history of money, the first thing we find out is this supposed history is completely false. Completely false. There's no evidence whatsoever. So David Graeber's book, Dead the First 5,000 Years, written by an anthropologist who actually knows what he's talking about, unlike economists who have no idea what they're talking about when they talk about the history, ancient history, going back to tribal society and so on. There's no evidence of barter-based exchange. There's no evidence there were markets before money. In fact, all the evidence, and it's pretty good now, we have lots of research on Babylonia, Mesopotamia, and so on. We find out that story is completely wrong. Money pre-existed markets. Money didn't come out of markets. Money came out of authorities. The purpose of money from the very beginning was to move resources to the authorities. Okay? Now, those authorities aren't necessarily always benign. You can have evil authorities. You can have democratic authorities. Okay, but the purpose of the monetary system from the point of view of those who create the monetary system and create money from the very beginning has been to mobilize resources. Okay, now today we live in democracies, or at least we hope we do. And we want the authorities to do things that are in the public interest. That means our interest, through our democratically elected representatives. And so this isn't something that we fear, okay, that the monetary system by design is to give this power to the authorities because they're our authorities, at least in principle. We elect them. They represent us. And they are there to do what's in the public interest. And that is really what our monetary system is about. Okay? That leads to a completely different view of, not just money, but of the economy itself. Okay? The monetary system was not an invention of the market system. The market system pursues a private interest, okay, which may be consistent with the public interest in some cases. In other cases, it may not be in the public interest. And when it's not, our representatives ought to protect us, okay? And so people talk about, well, the private market is supreme and the government is a dangerous intervention into the market system that is somehow natural. Okay, well, my view is that's completely wrong. We can permit private markets and we can permit them to pursue private interests, but only if it's not against the public interest. Wherever it's not against the public interest, we need to control it. We need to direct their efforts to things that promote the public interest. This is a very different view than what the neoclassical economists are trying to sell us. And they use their money story and their fictitious story about markets and how that's natural, that people have some natural instinct to truck and barter, and the monetary system helps them to do that. It's a more efficient way of doing it than barter. That all leads to a particular view of the relation between our government and the private markets that is dangerous.
Thank you so much. I think Aiden wanted to ask a question next.
Yep. All right. So my question is with interest rates and asset price inflation. is, do you think lower interest rates contribute to asset price inflation?
By themselves, no, I don't. So we have, of course, a bubble. We probably have the biggest bubble in asset prices in human history. So you all, I'm sure you studied the tulip bulb mania, but that's nothing compared to what we have going on here. This is it. This is the biggest stock market bubble in human history, and then we've got these other speculative so-called assets that are not assets at all, bitcoins and so on. These dwarf bitcoins alone dwarfs tulip bulb bubbles. Okay, so yeah, we have huge bubbles, and so people want to link that to the low interest rate policy. But I would say that Keynes in chapter 24, so John Maynard Keynes, General Theory, chapter 24, advocates euthanasia of the rentier class. You know what euthanasia means. It means kill them, okay? He didn't mean kill them with a bullet through the head. What he meant was kill them by driving the overnight interest rate, which is a risk-free interest rate, to zero. Today we call that ZIRP, zero interest rate policy, which is pretty much what central banks have been doing since the global financial crisis. Okay, so what we've been doing is exactly what Keynes recommended. All right. And so I think it's a little ironic that some people who consider themselves to be followers of Keynes are now arguing against low interest rate policy and blaming it for these bubbles. Okay, but this was Keynes's recommendation: zero interest rate policy. And Warren Mosler, Bill Mitchell, Statter have all argued the natural rate of interest is zero. And this is pretty much along the lines, I don't think that they're invoking Keynes and euthanasia of the rentier in their argument, but it's along the lines of what Keynes is arguing too. Keynes didn't see this as being natural, but he saw it as being something we should pursue. Okay, why do we want to do that? Because he did not want to reward the rentier class. And he defines a rentier class as people who earn a return without taking any risk. Okay, Keynes did believe that if you took risks, you should earn interest. And if you take risks in your investment projects, you should earn profits. So it's not that he's against interest and profits. He's against a risk-free return, which is what the Fed funds interest rate is. We also could say short-term government debt is risk-free, so its interest rate also should be zero. Long-term government debt, there is a risk. It's not of default because the federal government's not going to default on debt, but it is a capital loss risk. If the Fed ever does raise interest rates again, then we're going to have capital losses on long-term bonds. So we need to compensate them with an interest rate above 2% probably. So anyway, you're not going to get all the government bond rates to zero, but you'll get the short ones to zero. Corporate bonds will still have a positive interest rate because those are risky. Corporations can be forced to default. Okay, so other interest rates will be above zero, but the overnight rate and the 30-day bill rate on treasuries, those are going to be zero. That was a permanent policy, not a policy for recessions, not a policy for COVID pandemics. That's permanent in Keynes. So it eliminates a risk-free income. That's eliminated. Which will help to reduce inequality because his view is mostly these are high income people. that are getting this risk-free return. So it will help to reduce inequality. The other thing that it does is it sets a lower standard that has to be beat by investment in capital equipment. So it's going to lower the return you must get to induce you to be willing to take the risks of investing in real plant and equipment. So it's going to promote more investment, which he also saw as something that will tend to reduce inequality, because it's going to reduce the return to investing. We'll get more investing, but it will require a lower return. It will increase aggregate demand. It will increase employment. It will increase economic growth. So for all those reasons, he wanted a permanent low interest rate. Now, people think that, well, but if the interest rate is low, then people don't want to hold bonds. They don't want to hold deposits in banks because the interest rate is too low. And if you can get a higher return in the stock market or in Bitcoins or in CDO squared and CDO cubed, then there's a greater incentive to move into those things, and then you can get speculative bubbles. I think the answer to that is not to have a higher interest rate, because then you're not achieving those goals that Keynes was pursuing. A better thing is regulating. So going back to what I was saying earlier, whatever the private sector decides to do doesn't necessarily mean that what they're doing is in the public interest. Okay, there is no public interest in allowing speculation in Bitcoins. There is no public interest in allowing corporations to boost their stock prices by using all of their profits to buy back their own stocks from their top management, which is what drove the bubble. That's what created the stock market bubble. It was firms buying back their own stocks to drive up the prices, to reward all their top executives who had stock options. Okay, so this bubble was created, okay, by behavior that should be illegal. There's no reason to allow corporations to buy their own stocks. It should be illegal. Just prohibit it. We wouldn't have gotten this bubble. Okay, and we should not allow obvious fraudulent behavior, obvious criminal behavior that has been going on at the biggest banks, at least since the 90s, and continues to this day. So all we have to do, for the most part, we don't even need new laws. We just need enforcement of laws. So I think that is a much better way to tackle the problem of excess speculation. Eliminate the speculation directly. Don't try to divert the funds into bonds and banks by raising the interest rate in order to compete with a stock market bubble. That doesn't make any sense.
All right, thank you.
Okay, so just to stick on the topic of interest rate policy really quick. So you explained the position that you and various other MMTers hold. And I would just be curious to hear why you would be against something such as the fair rate of interest that Mark Lavoie and Passanetti, I believe, was the one who originated it, proposed, that would keep the interest rate in line with the rate of growth of labor productivity. So I'd just be curious to hear why you would prefer the zero interest rate policy over the fair rate of interest policy.
Well, so first, I don't think there's anything fair about letting functionless rentiers get a return for doing nothing. Okay, just holding on to bonds. Why should we promote that? I don't think that that's fair. I think there's also a bit of a difference of view about interest rates between, say, followers of Keynes like me and Lavoie and Passanetti, who they focus on a real interest rate. They want the nominal rate to adjust for inflation, so like through the Fisher effect. So if inflation goes to 6% and you want people to be able to get a 2% return in real terms, then you need the interest rate to go to 8% in order to get a real return. So that's the Fisher equation. And they have something like that in mind because they're thinking of people earning interest in nominal terms, but they want to be able to buy a basket of goods in real terms. And if that basket of goods is going up in nominal price, you need higher nominal interest rates in order to be able to afford that basket of goods. Okay? And so we want to reward the savers in order to keep a constant purchasing power in terms of the basket of goods of the interest they're earning on their saving. All right. The way that Keynes saw this is that there's nothing in the public interest in ensuring that savers get a positive return. There's no reason to be promoting saving. Saving is a deduction from the circular flow of income. It depresses aggregate demand. And there's no reason to reward people who aren't taking risk. So I view the interest rate in purely nominal terms. Okay, it's the interest rate and money and should only be thought of in nominal terms, not in real terms. So I also don't agree that we should be continually calculating what a given quantity of real money can, in real terms, can buy in terms of a basket of goods. That's not what is important. Financial assets are denominated in nominal terms, and people are always going to make their portfolio allocation decision based on the nominal returns, not on the real returns. You're going to take the best thing you can get, the best nominal return you can get, given your tolerance for risk. Okay, so I don't believe people make the kind of calculation they're assuming that they make. That is, whether or not I can buy the same basket of goods over time. It's just ranking all of the possible nominal returns and choosing the assets that fit with your given liquidity preference. So I wouldn't do it that way. Now, what do we do about people who are trying to save for their old age or trying to save to send their kids to college? And I think the idea behind the fair interest rate proposal is this concern that people do need to save for their retirement. They do need to save to send their kids to college, given the structure of the economy that we live in, because we don't take care of our elderly. We don't provide free college education. Okay, and so people need to accumulate mass sums of money. You need at least $1 million in savings to get you through your retirement years. You need up to $50,000 per year per child for college. Okay, these are huge sums of money because we're not providing adequately for college education or for retirement years. I think the better solution is to focus on that. Let's solve that problem. Let's guarantee everybody a decent retirement. Let's guarantee all students free college education. At least start out right now 4 years of free college, and then eventually we're going to have to add grad school to that too. So I think that's a much better solution.
Yeah, that makes sense now. Thanks for the explanation.
Sorry, what?
I said thanks for the explanation. It makes more sense now why you prefer the ZIRP over the fair rate. Thank you.
Thank you. I have a question. I was wondering a question. I asked people on Twitter to submit any questions before, and a question that I got was, are banks still reserve constraints because they think that many endogenous proponents claim no, or is it merely like a capital constraint by financial regulators?
Yeah, banks definitely are not reserve constrained. They have not been reserve constrained, probably in the sense that the textbooks used to teach. They were never reserve constrained in that sense. Previous to 1980, we had some constraints on banks that made it a little bit more difficult for them to get the reserves that they wanted without going to the Fed. Okay, the Fed funds market is pretty old, so banks could borrow reserves from each other, but if the Fed was not supplying enough reserves and forced banks to the discount window to borrow, maybe there were what was called the frown effects, that if you have to go to the discount window, it is thought that there might be something wrong with you. And we had Regulation Q, which made it hard for banks to compete for deposits, which made it harder to force reserves in your direction. You couldn't just raise the interest rate to depositors because we regulated the interest rate on deposits. So before 1980, maybe you could argue that there was a bit of a constraint on banks. But after 1980, when we got rid of the Regulation Q, no, you can't really say that they are or have been reserve constrained for a very long time. So this is Basel Moore's argument. And the structuralists like Pally tried to argue against this. But I think that all post-Keynesians now accept that Basel Moore was right on this point. The capital constraints, it's good you added regulators at the end, because capital constraints will not constrain banks at all unless they're enforced. So because especially when banks get in trouble and their capital ratio goes down, the closer it gets to zero, the less it constrains them, because they do what we call bet the bank. They make the craziest loans possible because, hey, all the equity's already gone. We got nothing to lose. Let's just make big bets on very risky things, which is exactly what the thrifts did in the 1980s. They probably were all insolvent, probably every one of them. And so the regulators actually told them, you better make a lot of loans and grow really quickly and hope everything works out, because otherwise, you're going to go out of business. So that's what they did. And that's when they went around making loans for fur-bearing trout farms and other crazy stuff. Bought the Dallas Cowboy cheerleaders and houses of prostitution and stuff like that. Did all the crazy stuff that led to the saving and loan crisis. So yeah, the regulators have to enforce it, or even capital won't constrain them. What constrains them is the supply of willing borrowers and their willingness to take the risk on those borrowers. That's the constraint on banks.
Thank you. Does anyone else have any other questions? If not, I could go or pick a couple from the audience if you like.
I have a question. So I guess on the topic of banking and endogenous money, I was wondering, what banking regulation, just off the top of your head, do you propose for banks? Like, I know Bill Mitchell has, just off the top of my head, banks should only be able to lend directly to borrowers and should only be in the business of facilitating loans. So I wonder, what are your thoughts on that?
Yeah, I think that we need to move back to making loans and holding them. I think that that's the most important regulation that we need. So to reverse the course of history in the 1980s, partly because of Volcker's high interest rate policy, banks moved to securitization, and eventually they securitized everything. So everything is securitized, which means that they will originate a loan, a house. It could be a car loan. It can be a loan, and then they securitize them, package them together into security, and then sell them off to money managers, pension funds, things like that. And then they put together derivative products, which basically are bets on those securities, whether they will go good or go bad, and credit default swaps to that pay off if they go bad or if they don't go bad, which is a kind of an insurance. So banks will hold those, but they won't hold the loans they made. All right. When the global financial crisis hit, a lot of banks had lots of credit default swaps. So they were buying the insurance on the mortgage-backed securities that were that held mortgages as the collateral. So several degrees of separation. They had CDOs, CDO square, CDO cube. So they're carrying those things on their books, but not the mortgages themselves. So we need to reverse course and go back to making loans and holding those on their books. Because as we found out, and it didn't take a genius to predict what was going to happen, if you're not going to hold a mortgage, you're not going to do good underwriting. Okay, underwriting means determining whether the borrower is creditworthy and likely to make the payments. Because if you're going to immediately package that and sell it off, you don't care. And it turns out that decline of underwriting standards is what precipitates our financial crises. So if you don't care who you make a loan to, and the less you care about that, the sooner the crisis is going to come. So it sort of goes in waves. After a crisis, generally banks are more careful, but the farther we get away from the crisis, the more risks they take. And the underwriting standards decline to the point where they're making loans that have virtually no chance that the borrowers will make payments on the loans, which is where we were in 2007. There's virtually no chance those mortgages would be serviced by the debtors. So anyway, that's probably the most important thing to do. Now, our crises generally get started in the shadow banks. So even if we did everything that I just said and that Bill wants, if we don't do something about the shadow banks, we're not going to eliminate these serious financial crises. Our next crisis will start in the shadow banks, just like the last one. Then it spread rapidly through the big banks. And then when the economy went down, it hit the smaller banks too, which hadn't done the crazy stuff. So we also have to do something about the shadow banks. What Minsky recommended was, if a shadow bank does something that banks do, we have to regulate them the same way we regulate the bank. So in other words, if a shadow bank can originate a mortgage, we need to regulate them the same way we do a bank that can originate a mortgage. If a shadow bank can offer a deposit account, we have to regulate the same way that we regulate a bank that can issue a deposit account, so that we maintain competitive fairness. So the shadow bank can't get away with doing things, taking business away from banks, but not being regulated. But it's also a way to prevent the shadow banks from doing crazy things. So we will have to regulate them, and I think we need to downsize them by probably something like 90%. Reduce the size of the financial sector by 90%. Most of what the financial sector does today is opposed to the public interest, and so should be eliminated.
All right, thank you.
All right. I think Hasib would like to ask a question. Thank you for the answer, Mr. Ray.
Okay, yeah. So my question is about the job guarantee. And while I don't think most of the calls about inflation following the job guarantee really hold much substance, so one idea that I've heard and that I'm curious about is that it'll increase the proclivity towards wage price spirals by, I guess, putting more bargaining power in the hands of the workers. Do you think this is something that might occur? And also, do you think then that implementing policies such as, I believe I remember you mentioned in your section in the new guide to post-Keynesian economics, the tax-based income policies and the market-based anti-inflation policies, do you think these would need to be implemented in tandem with the job guarantee for it to function optimally, or no?
Well, the job guarantee wage helps to stabilize wages and prices. So could that help to fuel inflation? Well, it could if you're continually increasing the program wage. To the extent that you stabilize that wage, that is, you raise it infrequently, then it's always going to be reducing inflation and wage pressure. Okay, so in other words, it's not the job guarantee program that would tend to increase inflation pressures. It is the policy you adopt about the wage in the program. So what we would recommend is you set the wage at a relatively high level when you implement the program. So we have gone along with Bernie Sanders and many others in advocating $15 an hour. So that's double the current minimum wage. That will mean that the effective minimum wage for the whole country is going to be $15 an hour. Now, in some places it already is approaching 15, but large parts of the country, this is going to be a big boost to wages in the private sector. So that could lead to an adjustment to wages and prices in parts of the country. And we will measure some increase of the CPI. That is a price increase at the aggregate level. Now, that's not inflation. Inflation means a continuing increase in the price level. And as long as you hold the program wage at $15 an hour, you're not going to be generating any inflation pressure. There's a one-time jump, yes, but that's not inflation. That's adjusting upward all the wages all over all the lowest wages all over the economy to $15. And there will be some price increase because of that, which is okay. There also will be some firms that go out of business, which is also okay. So what if we lose the worst employers in the United States because they can't raise their wage? That's okay. The workers will get jobs in the job guarantee program at $15 an hour. Now, if you index the program wage to inflation, then you could build in a wage price spiral dynamic. And so we recommend against that. Will you have to occasionally raise the job guarantee wage? Yes, you will. Okay. It won't be the job guarantee program causing the inflation, but because of inflation, you would have to raise the job guarantee wage occasionally in the same way that we have to raise the minimum wage occasionally. Okay. That's to catch up with the inflation that occurs. But let me add one final point. I know there's this great fear of inflation. And people are afraid that the Biden plans will cause inflation. The $2 trillion with maybe another $3 trillion proposal yet to come. People are worried that this is going to cause inflation. Inflation ended a generation ago. Your generation has not seen any inflation in the United States. Okay, it ended before you were born. It ended maybe when your parents were young. Inflation is gone. It's not coming back. Okay, why? Because approximately 2 billion new workers came into the global economy. Those workers, lots of them are very low paid. Okay, they're outside the United States. They are holding down wage and price pressures. They limit how much US firms can raise prices domestically because there's always the threat of imports. So I think given the price dynamics in the world as a whole that we have had for the past 20 years, 30 years, it's very difficult to get inflation going in the developed countries. And what we see is their problem has been deflation, not inflation. And I think that we're going to continue to face those deflationary pressures as Asia continues on its development path and produces more and more stuff that can compete with the best American products. They're going to keep prices low. So I don't think that inflation is a legitimate fear at all.
Okay, thank you.
Thank you. That was a really good answer. Aiden said he'd like to go next, so floor is yours, Aiden.
All right. I guess my question is on the classification of modern monetary theory. Would you consider it different from post-Keynesian economics, distinct from it would be a better word, or as a branch of post-Keynesian economics?
Well, that's a little hard to answer. It started off mostly as a project of some post-Keynesian economists. Okay, so we all met on PKT, which was the post-Keynesian discussion group, and Warren came on in January. Well, I don't know when he came on. I know when he first posted. The first time I saw his post was January 1996. So I would say that is the date of the beginning of MMT, and it began on the post-Keynesian discussion group. So it is a project of post-Keynesian economics. And that is the way that we saw it. When we started our center at UMKC, Center for Full Employment and Price Stability, a couple years after that, we first started it at the Levy Institute, then we moved it in 99, I think, to UMKC. We thought of it as a post-Keynesian think tank, and we had conferences and we brought in post-Keynesians, and we had some post-Keynesians as visiting scholars in our group. We had affiliations with post-Keynesians at various universities around the world. We went to their universities, presented our ideas. So I think we all thought that this was a branch of that it was post-Keynesian economics. I wouldn't even say a branch. It was post-Keynesian economics, focusing on some particular issues that post-Keynesians had either not addressed or not understood. So we were trying to explain to them. UMKC also was a strong institutionalist school, and I was an institutionalist economist. I mean, I still am an institutionalist economist, so was Minsky. And so we also were promoting institutionalist ideas at the same time. Okay, anyway, but what happened was, it was very, very strange. Many post-Keynesians turned against us and basically threw us out. So it wasn't that, we chose to do non-post-Keynesian economics, or we chose to separate ourselves from them, they threw us out. They threw us out of the journals. They would not allow our articles to be published. Still don't. I mean, still in a very recent case, an article that I co-authored, a prominent post-Keynesian tried to get the journal, which had already published the article online, tried to get the journal to remove it online. This happened within the past year. Still, they are still trying to prevent us from publishing in what they see as their journals. Okay, so MMT is supposed to be banned from journals that post-Keynesians think are their journals. So they have tried to separate us from post-Keynesians. It wasn't us.
Yeah, and I never really understood the division that well. It seemed like post-Keynesian economics and MMT were always really in line with each other.
I think they are. I think there are some post-Keynesians who are very, very bad at post-Keynesian economics. Unfortunately,
I agree.
A lot of them are very bad at following Keynes, which post-Keynesians are supposed to be followers of Keynes. A lot of them are very bad at following Keynes. I think that everything I do follows Keynes, follows Minsky, is consistent with Keynes and Minsky. So I don't see MMT as being separate from them at all.
All right, thank you.
Thank you so much for that answer. I think Tanish wanted to go next, so the floor is yours, Tanish.
Yeah, hopefully I don't cut out this time. But so obviously in more recent time, especially in America, we've been seeing MMT ideals become more mainstream, especially with the release of Mrs. Kelton's books. So my question to you is, how long do you think it's going to take for MMT to fight off the mainstream economic idea, I guess, sort of say? Because, a lot of people are still looking to Paul Krugman over some others for economic advice, and it seems we're still stuck in this stage of neoliberalism. So what would you say the steps are to get there, and how long do you think it'll take to get there?
Okay. Well, I'll quote Paul Samuelson, one death at a time. So it's slow. One death at a time. In academics, it's going to be dominated by the prominent mainstream people. And this is what he was referring to. So when will academics change? Well, when they're all dead. That's when it will change. When the young people like you take over. Okay, so it won't change before that. So that's very slow. When we first started, Warren was really optimistic. He thought, well, all we have to do is explain this to them, and they must be smart. They got PhDs. We'll explain it to them. We'll win them over. And, I was always skeptical because I know the way academics are. The last time they truly study and think is when they write their dissertation. Okay. And then after that, they have already got their framework. They spent so much time on this dissertation, very, very difficult for them to go in a different direction. Okay. Virtually impossible. So once they've already gotten out there and they spent all the time on the dissertation and they get their job, it's probably too late. So it has to be the younger generations. That's why we went to UMKC, because we could teach graduate students. So it has to be the new generations. But that doesn't mean that it's hopeless in policy, because the way that the politicians work in politics is that they find the academics that are presenting the views that they want. Okay, so if the politicians are all neoliberals, which academics are they going to seek out? Neoliberals. Okay, but once politics has made the shift, and hopefully we are making that shift, once they've made the shift, they're going to seek out the economists that will justify what they want to do. So if Biden is right, and we're entering a new era in which the government takes an active role in the economy, neoliberal economists become absolutely useless, and so they're not going to go to them. Okay, I mean, Larry Summers has become an embarrassment for policymakers. 10 years ago, Larry Summers was, in their view, the most brilliant, the top economist there is in the world, because he was saying deregulate. In fact, don't just deregulate, prohibit regulation of credit default swaps. So they could push Larry Summers up in the front, great economist, saying, yeah, we should prohibit anybody from regulating credit default swaps, because he was preaching what they wanted to promote. But now he's out there saying, oh no, Biden, there's a 1/3 chance that Biden is going to create out of control inflation. Well, now that's an embarrassment. You don't want to put this guy out in front anymore. I know the media is still interviewing him, but there's no way that an administration that is trying to leave behind the neoliberal era is going to be putting him out in front. So I'm much more hopeful than I ever thought I would be about Biden, because I was not a supporter and not enthusiastic. But so far there are some good things, and maybe he really does want to change things. And if he does, there are economists he can get out in front. And he can just forget about people like Larry Summers.
Thank you for that answer. I'd like to go to a couple questions from the audience. Here's Frank. He just wanted to say a couple things to you beforehand, and here's his question. Austrian business cycle. Honestly, I have to tell you, I have no idea what it is. No idea. Completely incomprehensible. I mean, I can't make any sense of it whatsoever. So there's just no way I can talk about it. I have views on Austrians, free marketers, far right-wing politics and policy. Now, I know that students a lot of times don't like it when I say that, because on some issues, they free speech and so on, they at least say that they support that stuff, and students generally like free speech, and those let people be free to do what they want to do. Libertarian sorts of ideas is very appealing to students. I understand that, but I see them as wolves in sheep clothing or whatever. They're on the wrong side, and their theory is incomprehensible. I'm not joking about that. To me, it's incomprehensible. I have no idea. Read Keynes on their theory of capital in the general theory, where Keynes says, the roundaboutness, it's so silly that he sort of makes a joke and said they might as well claim that capital gets a return because it's smelly. That would make as much sense as their theory does. Okay. I have a question for myself. It was also submitted by Twitter. It said, what do you think of some of the good faith criticisms, or if you think there are any, about MMT from other post-Keynesians?
I haven't seen one of those.
All right.
I haven't seen a good faith. I haven't seen any criticism that holds up coming from post-Keynesians. Not one. If they ever make one, I'll be glad to read it and try to deal with it, but I have not seen one. All the ones I've seen are bad faith. What they do is they misstate what we say. okay, and take that and then run with it and say, well, yeah, but we never said that. That's not part of MMT. Their criticism is always of that nature. So I haven't seen one yet. I'm waiting.
Yeah. Another question I had for myself is, why do post-Keynesians reject Say's law?
Well, all Keynesians reject Say's law.
Yeah. Okay. Why do all Keynesians reject?
Because it's a fallacy. It's a logical fallacy. So the idea is that supply creates its own demand, which would be true if it weren't a monetary economy. Okay, so if we were in a real barter world, it would make some kind of sense. But I mean, because I wouldn't offer you a banana for a coconut unless I wanted the coconut. So it's true in a barter economy. But in a monetary economy, just because I receive income doesn't mean I'm going to spend it. Okay, so Keynes spent a lot of time in the general theory refuting this notion. Firms know this is true. That's why they won't hire up to the full employment level. They only hire the amount of labor they think they need to produce the amount of output they think they can sell at a profit. Okay, now if Say's law hold, as Keynes said, then they'd be safe to produce up to the full employment level, because the supply is going to create the demand. Okay, but that's not true, because just because I've paid income to somebody doesn't mean that they're going to buy my output. Okay, up to the amount that I spent in order to produce it. So it's just logically flawed. They thought they could rectify that problem with the loanable funds market, which is the idea that if I reduce my consumption, that means I'm saving. And if I'm saving, that means I'm investing. Okay? The loanable funds market ensures that, because an act of saving will lower the interest rate. And if investment is a function of the interest rate, then investment goes up. All right? But Keynes goes through and demonstrates several problems for that. But the easiest way to explain it is that if I'm saving in a monetary economy, I don't have to buy plant and equipment. I have other ways to store my saving. I can save it in a financial form. And my degree of liquidity preference determines the degree to which I want liquid assets. And liquid assets do not lead to employment. That's the problem. Okay, if the only way I could save was in the form of building plant and equipment, then loanable funds theory would hold. But I don't have to save in that form. In fact, almost no savers save in that form. They save in liquid form, okay, of varying degrees of liquidity. So it breaks the link. A reduction of consumption does not lead to an increase of investment. In fact, in the real world, a reduction of consumption is likely to lead to a reduction of investment, because what firms see is that consumer purchases are declining, and so they say, it's going to be harder to sell stuff. I'm going to stop investing. Okay, so you're more likely to have investment going down, not up, when people reduce consumption. So it's just not going to work.
All right, thank you so much for that answer. I think Seed would like to go next, and then after that, Aiden. So the floor is yours, Seed.
So just curious regarding business cycle theories, would you consider yourself to be in agreement with Keynes's theory with regards to like the marginal efficiency of capital and the fluctuation within it?
Okay, most of the general theory is not about the cycle. The general theory is about explaining the theory of effective demand. Okay, And that is, at a point in time. It's not a theory of the cycle. It is, what does that equilibrium point look like? And it's providing a contrast to the neoclassical theory of equilibrium. Neoclassical theory of equilibrium, the equilibrium point is full employment. Okay, it's ensured by flexible wages and prices. For Keynes, the equilibrium point is the point of effective demand. And that is where, as I just said, firms are employing the number of workers they think they need to produce the amount of output they think they can sell. No reason for that to be full employment. There are unemployed people out there, but the firms don't hire them because they don't think it's going to be profitable. They only hire when they think it will be profitable. Okay, so that's what the majority of the general theory is about. He does have one chapter on the trade cycle. Okay, and it's not a very complete theory of the business cycle, but it's based on effective demand, and it's based on mostly the component of effective demand that fluctuates the most. What is that? Investment. So he has chapter 12 explaining why investment is so unstable, because you invest based on your expectations about an uncertain future. And the amount of uncertainty goes up and down, okay, optimism and pessimism. So it's an investment theory of the business cycle and a liquidity preference theory of investment. So in two phrases, that's his theory of the business cycle. It's not very fleshed out. So it was Minsky who then took that and created a theory of cyclical behavior. And that is financial theory of investment theory of the cycle. So Minsky, stood on Keynes's shoulders and developed the theory more.
Okay, and then just to follow up really quick then, I'm pretty sure, I believe it was Calder, was it, that also tried to flesh out a more, like, I guess, full trade cycle theory that he did in one of his papers. Do you think that that holds any merit today or no?
Well, I'm sure that there could be some interesting things in there, and you might be thinking of Koleski, who was more famous for developing the dynamics of the movement through time, which is what we call the cycle. So Koleski is probably even better. But Minsky was my teacher, and I think Minsky is the best. I think Minsky is the greatest economist of the second half of the 20th century, and he is the greatest economist on studying financial instability. And I think that the other approaches don't put enough emphasis on the finance. That's where Minsky stands out. And in a way, that's what makes him more institutionalist than the followers of Keynes, other followers of Keynes, and in a way also makes him more like Veblen. So I think if you want to go back and read, who was better on the business cycle, Keynes or Veblen? Veblen is much better. Okay, on the theory of effective demand, liquidity preference, I prefer Keynes. But for a theory of the cycle, I think that Veblen is better. And then that whole institutionalist tradition is better than the Keynesian tradition. That's my view.
Okay, thank you.
I think Aiden wanted to go next, so the floor is yours, Aiden.
All right. So my question has to do with inflation. It's just, does modern monetary theory have a specific theory of inflation? I know in the macroeconomics textbook, you present a distributional theory of inflation, and you present the quantity theory. You might have presented one more, I don't remember. So does MMT have a specific theory of inflation?
No, it's a, what we present in the textbook is a conflict theory of inflation. So it's a conflict between capitalists and workers. So it's a Keyneskian theory. I think probably Bill wrote most of that part of the textbook. Bill is a Keyneskian. And it's consistent with post-Keynesians, which have a cost plus markup. So the labor is the cost part. So when workers struggle and they get their wages increased, that can generate an increase of the price. So what the capitalists want to do, if they had to raise the wage, they need to increase the price in order to protect their profits. Okay, so they take the wage increase and add a markup so the price level will be higher. So this struggle between workers and capitalists lead to the prices increasing. And, if both sides are strong, then when the capitalist raises the price, what do the workers do? They demand a higher wage. What do the capitalists do? Higher price, higher wage, higher price. So that's the conflict theory. So this is a general post-Keynesian theory. So then there's more discussion about the power of workers to raise wages. How strong are they? The markup, how strong are capitalists? But also, how is the markup set? Okay, generally it's related to market power. So if you're a firm with more market power has more power to set their markup. If we have an increasing monopolization of our economy, the markups will tend to go up. So that will tend to mean high prices going up as we get increased concentration among the biggest firms. So all of that is traditional post-Keynesian. In addition, and this is not in the textbook, we could do more with Minsky's approach, which is based on an aggregate markup. And if you know the Keyneski profit equation, Keyneski demonstrates that profits at the aggregate level are identically equal to investment plus the budget deficit plus net exports minus saving out of wages plus consumption out of profits. That's the full equation. You can ignore the final two for the most part. But the point is that if the deficit is rising, that will tend to increase profits. If investment is rising, that will increase profits. And if net exports is increasing, that will increase profits. So Minsky then goes into an analysis in his stabilizing book, and then later in draft manuscripts. He was writing a book when he died that didn't get finished, to have a theory of inflation based on the aggregate markup rising, which itself is a function of a rising share going to the investment sector. So or the net export sector. So basically, you then link the markup to the percentage of workers in the economy that are in the government sector, investment sector, and net export sector. All of those will tend to increase the size of the markup and therefore the price level.
All right. If you guys don't mind, I'm going to ask a follow-up question. You also present the Phillips curve in the book and the expectations augmented Phillips curve. So I was wondering if you believe that the Phillips curve exists, or if if you believe it exists, that it has flattened.
No, I think empirically it does not exist. Okay, if you just plot the unemployment and inflation data as dots over the years, and you'll see that it doesn't fit. It's just a scatter diagram. They're everywhere. The dots are everywhere. So every macro textbook has to present the Phillips curve and Friedman's augmented Phillips curve. So we present it. But again, our theory of inflation is not this due to low unemployment. It's due to this conflict. And it could be true that a high employment economy strengthens the power of workers. So that could contribute to wage increase. But in the certainly in the case of the United States, the power of workers has been going down since 1960. So that couldn't be an explanation of inflation in the U.S. Instead, it's and we do talk about these things in the textbook. The unemployment has become pretty useless as a way to prevent wage increases. And the reason is because so much of the labor force or potential labor force is not a reserve army that can be used to discipline labor because the private sector won't hire them. So it's a very inefficient way to try to keep wages and prices down because unemployed workers act as a substitute only if the private sector thinks they're employable. But a larger and larger percent of our people without jobs are not considered to be employable, usually because they've been unemployed too long. That's why we promote the employed buffer stock scheme, which we call a job guarantee, over an unemployed reserve army. So an employed reserve army does a better job than an unemployed reserve army.
All right, thank you.
Thank you. I recently Biden is sought to increase corporate taxes, and I know that I don't want to straw man. You feel that corporate taxes are regressive, and I was wondering if you could elaborate on that opinion and what your thoughts are on a potential corporate tax increase.
Well, so in theory, corporate taxes are paid by three groups of people. Okay. And many progressives think that corporate taxes are mainly paid by stockholders. And stockholders are generally higher income. Therefore, the corporate tax is a progressive tax. Okay. However, theoretically, what corporations with pricing power can do is pass on the tax to consumers. So all they do is raise their price to cover the taxes. In that case, it's consumers paying the tax. So that's not progressive. Okay. The marginal propensity to consume of low-income people is much higher than the marginal propensity to consume of high-income people. So it's actually a regressive tax. Okay. And then the third group is the workers. If workers are weak, what corporations can do is pass on the tax to workers in the form of lower wages. Okay. So all three of these groups can share the burden. So the question is empirically, which of these is most plausible, and there is debate about this. Okay, and the honest answer is we don't know precisely what that share is. Musgrave actually, husband and wife team, wrote the most famous textbook on public finance. And they tried to do estimates. And their belief was that based on the empirical data, a large share, the majority of the corporate tax is passed forward to consumers and backward to workers. And that shareholders paid a small portion of the tax. Some of this is based on theory of capital movements, that capital will flow out of high corporate tax countries, states, or whatever, to escape that, or that they will choose not to be corporations to avoid the tax. So through those combinations, you reduce, the percentage of the capital that is in the hands of corporations in the national economy, and so they avoid paying the corporate tax by doing that. So that means that you're actually not hitting much of the profits. Okay, because either they're locating abroad, offshoring, or they are moving to partnerships or some other form that doesn't have to pay the corporate income tax. So my belief is a significant portion is not paid by stockholders. Then the final point is, not all stockholders are rich people. Okay. Institutions hold stocks. My pension funds hold stocks. Okay, so the pension funds themselves are owned by workers in a lot of cases through institutions. And so, again, it's not clear that that's a progressive tax. If you're hitting pension funds, that may not be a progressive tax. So this is called the incidence of the tax. Who really pays it? Well, okay, so rich shareholders pay some portion of it. It's uncertain how much, and it's probably not that great. So a large part of the tax is not paid by them. So it's not the best way to tax rich people. You want to tax rich people? Tax their income, tax their wealth. So I would much prefer to do that. If our goal is to reduce the richness of rich people, we should be taxing rich people, not corporations. Okay. Then there are other issues, like how many corporations move offshore because of corporate taxes? Well, quite a few do. Pretend like they live in Ireland, like Apple does, so they don't pay any tax. Okay, so you encourage that sort of behavior. You encourage evasion. You encourage, which is illegal. You encourage avoidance. You encourage the whole tax accounting sector. You create tons of jobs for people doing something that's pretty useless, really, trying to reduce the corporate tax burden. You create lots of campaign donations to Congress critters who promise to fight against a corporate income tax. So you create lots of lobbying. The estimate is that corporations spend about as much on all the techniques to avoid paying tax as they do paying the tax. Okay. And what that means is there's this notion of excess burden. You're imposing a big burden on the economy in order to collect a relatively small amount of tax revenue. And of course, from an MMT point of view, we don't even need the tax revenue. So why are we doing this? Okay. The final point I'll make is, we invented incorporation to ensure that firms pursue the public purpose. That was the whole idea behind corporations. the corporations have to get a charter to operate. That charter is supposed to limit what they can do. And so, yes, they can pursue some public interest, that is, make profits, but they have to pursue the public purpose. And my view is, rather than taxing them, let's make them pursue the public purpose. Let's prevent them from working against the public interest. Right now there's this debate about Delta and Coca-Cola and so on, whether they should or should not promote, say, Black Lives Matter. Okay? And people say, well, hold it, that interferes with the private market, and, corporations should not be involved in politics and all this stuff. Well, hold it a second. Corporations are supposed to pursue the public interest, and let's force them to do it. Okay, and the way you do that is with the charters. Okay, we put things in the charters to make sure they are promoting it. So it's definitely not, there's no justification for saying, well, corporations shouldn't be promoting racial equality. Of course they should, and it should be written right into their charters. So that's the way I would control them, rather than trying to do it through corporate profits.
Thank you so much. One question I got from Twitter was they were asking your thoughts on Basel regulators.
Well, okay, I have not looked at the latest rounds. Back in, I think, 2005, I was studying it. We had a conference on it. I studied it. I wrote a paper for it. You can find it at Levy, and it's published in a book too. So up through Basel II, I was pretty familiar with what they were doing. First, it's better than nothing. Okay, so we're trying to sort of have international agreements on how we should regulate financial institutions. The reason why it needs to be international is because financial institutions operate across borders, and they can do the kinds of things that I was talking about. They can run to the countries that have the most lax regulation, so that they can get away with doing things. So we do need to align international regulations if we're going to let financial institutions operate across borders. The other solution is make that illegal. I would probably prefer that one. Just say no more international banking, only domestic banking. Goldman Sachs should not be able to operate in multiple countries. They should only be allowed to operate in one. Hopefully not the United States. I would try to push them off, let England have them, and try to handle them. Anyway, but if you're going to let them operate across borders, we need international agreements on how to regulate them. So that is good. But generally, Basel thinks that you can come up with mathematical formulas that will make them safe, such as capital ratios. Okay. And what they did is they had tiered capital ratios. So if you held this kind of an asset, you had to have this ratio of capital. If you held this kind of asset, you had to have this ratio of capital. But within each category, there was a range of riskiness. So what the financial institutions were sort of incentivized to do is to take the riskiest asset in each one of those classifications. So they had the greatest risk possible against each, capital allocated to that class of assets. And so you actually were encouraging them to take risk. Capital ratios are not a good way to regulate banks. You need to regulate their asset side, which I said earlier. You've got to look at their assets and regulate those. Regulate their behavior, regulate what kind of assets they can hold. And that's a better approach than simple formulas like capital ratios. Now, as I said, I have not been following them closely. I think that they are moving away from simple numbers, simple ratios, because I think they found with the global financial crisis that what they were doing was not working.
Thank you. Hasib, he has a question if you'd like to go, Hasib. Hasib? He said his mic isn't working, so I guess you could probably type if you want, and while Steve tries to get his mic working, Aiden, do you have a question?
No, I think I've had all mine answered.
Yeah, I guess we could look for the chat. These are a couple things that people have said in chat. A lot of support for you. One person in the chat, I guess this is like a less economic space, but they just asked who your favorite president was.
Well, of my lifetime, Kennedy, but I was young. FDR, of all the presidents, Roosevelt.
And they also asked, I'm pretty sure you already addressed it earlier, but I guess they weren't here. Like, if you're like a big fan of Biden, that's what they.
Well, no, I was not. But I've been pleasantly surprised so far. Better than I expected. He's in a very tough situation. So he proposes very good things, and then he has to back off. So the question is, how far is he going to back off the things that I think he understands he needs to do, and whether he really has to back off the way that he is and give in, throw away the $15 an hour minimum wage, throw away Medicare for all. So if he sheds all the really good stuff, then he's not going to be a good president, and he's not going to be reelected. Yeah. I think to be reelected, he has to be pretty close to great. And if he did what he proposed, I say the limits of what he proposed, and got most of it, he would be a great president. So yeah. The proposals are good. And if he really accomplished it, I think assuming he's alive, he would be reelected. But if he's mediocre, unfortunately, you can look forward to Trump.
This was one from his seed question.
On formal models, well, stock flow consistent models, MMT is stock flow consistent. Okay, always has been. We think that way. Minsky thought that way. Minsky's own work was stock flow consistent. So analysis has to be stock flow consistent. Okay, now the models that people are developing add behavioral equations to them, because stock flow consistent doesn't really tell you what the model is going to look like. So the actual models people are using try to put the behavior into a stock flow consistent model, right? No, I have not looked. So you asked about Dirk's I have not looked at his model. Steve Keen has lots of models. I don't look at those models. The model that I like is Keynes's own model, the D and Z curve model, which is in our textbook. And then we carry on with that model to flesh out what a Keynesian demand curve looks like and a Keynesian supply curve look like, both for the aggregate demand and income and for employment. Okay, those models are stock flow consistent. They're not trying to get into the details of assuming, what the propensity to consume is and so on. So they're not comparable to the neoclassical Keynesian models, and probably not comparable to what Steve Keen is trying to do.
This was a question from Chad.
Inverse quantity, I have no idea what those are. Endogenous money, post-Keynesian endogenous money is an anti-quantity theory. Keynes is an anti-quantity theory. So I'm not sure what those mean.
There's also another
Nick,
question.
if you don't mind, I have a question.
Yeah.
All right. Well, actually, I have 2 questions. You mentioned Steve Keen and his dynamic modeling approach to economics and modeling. So just what are your general thoughts on that? I guess you already stated some. So
I really don't. I don't follow that. I think they've gotten better. I remember in the beginning, Steve Keen had single entry bookkeeping. He thought you only needed an entry on one side of the balance sheet. So then after several years, he discovered double entry bookkeeping. So that was an improvement. But if you're doing money, it has to be quadruple entry. So until he gets to the quadruple entry bookkeeping, I don't think the models are coherent. So I don't know. I haven't looked at any of that for years and years and years.
all right, thank you. And then I guess
He also used to say debt is debt. It doesn't matter if it's government debt or private sector debt. Debt is debt, which obviously is not consistent with MMT. Sorry, go ahead.
all right, just to add on to what you said. Yeah, I've been following Steve Keen for a little bit now. Yeah, he's definitely changed his view on that. It seems like over time it's become more friendly to MMT, definitely. All right,
That's
and
good.
then I guess my question is unrelated to Steve Keen or really economics, well, not, but it's when did you really get into economics and what was your beginning motivation?
Okay. My concentration as an undergraduate was psychology. I didn't take any economics, and I was going to be probably a 4th grade elementary school teacher. That was my goal. And when I got out, there were almost no teaching positions. And so I ended up working for the government in public works in an engineering department. And I was writing the specification for garbage trucks. And I helped to plan one of the first curbside recycling programs in the 1970s. Anyway, I had student loans, and as long as you were in school, you could postpone paying the student debt back. So I was taking night classes, mostly in things related to psychology and children, child psychology, child nutrition, things like that. But I found out that the government would pay my college fees if I took something related to the job. So I asked my boss, and he had just taken an economics course. and he loved it. So he said, why don't you try economics? And then he could sign off on it, as related to my job, because I was doing cost benefit analysis. So I started taking it, and that's how I got into it. So it was definitely never part of my plan. And I was very lucky to go to California State University, Sacramento, which had Marxists, institutionalists, and neoclassicals. So from the very beginning, I was able to study non-neoclassical, that is institutionalist and Marxist. And that was the interesting stuff. The neoclassical stuff I liked because it was so easy. If you do a little bit of math, there's always a right answer. And it was very easy to get everything right. So I like those classes for that reason, but there's nothing interesting at all and nothing relevant to the real world, which I understood immediately from the very first class. There was nothing relevant. I learned nothing that was useful in my job. My boss thought I would. There was nothing useful at all. But it was the institutionalist and Marxist teachers that convinced me to go on. And that's why I went to study with Minsky later.
Kind of building off of that question, I was wondering if you had any advice for young people like us when it comes to getting into economics.
Well, you definitely need to go to a college that has alternatives to neoclassical economics. Otherwise, it's going to be very painful. You're not going to learn anything useful. It's all, angels on pinheads. That's all it is. Angels on pinheads. How fast can they spin? It's medieval clerics. And you can get a career with that. Most people completely burn out. When I went to the PhD program, I went to study with Minsky, so I had an idea what I was going to be focused on, but I also understood the whole game of neoclassical economics, what it was all about. And the students who were actually interested in trying to learn how the real economy works, the interesting students, the more progressive students, for the most part, they didn't last. At the end of year one, they said, I just can't do this anymore. There's nothing here I'm interested in. So the problem was they couldn't survive. If they could have gotten through, they probably, would have had decent careers and done interesting stuff, but they just couldn't put up with the classes they had to take. So that's one problem. But even the ones, who didn't care, they were good at math, and the PhD level neoclassical courses are mostly math courses. So the work for them was interesting enough because they liked the math, and easy enough because they were good at it. Their problem is that they have no ideas. So when it came time to write a dissertation, they had no ideas. They couldn't think of anything to write a dissertation on. Even if they got the dissertation, what tends to happen to neoclassical economists is, okay, they get a dissertation. What they do is they take some tiny little insignificant thing, little insignificant idea, mathematize it, write 3 essays, 3 chapters, call that a dissertation, get their PhD, get a job, publish 2 articles based on their dissertation. And because they have no ideas, they don't know how the economy works, they can't write about the actual economy that is out there, they don't produce anything. That's it. Their whole career is 2 articles. That's all they've done. And the articles are read by nobody. Maybe their dissertation advisor. That's it. Maybe their mom, said, okay, I'll try to read the article, being proud that their kid published something. But they have pretty miserable lives. A lot of people think that it's easy to be a neoclassical economist because almost all the journals and all the top-ranked journals are neoclassical, but actually it's a huge struggle to be a neoclassical economist because they aren't prepared to think. That's not part of the graduate program, and they don't know anything about how the economy actually works. They don't do anything interesting that anyone would want to read. So they have pretty miserable careers, the majority of them, which is why academic economics can be a very sad place to be. I've always been lucky because I've been in heterodox departments with interesting people. You could have good, interesting discussions and generally nice people. That's not the situation in most economics departments. You have very frustrated people, very antisociable people. So anyway, I'm not trying to talk you out of anything. I'm just saying, you need to go to a department that has alternative views. Liberal arts, I think, is much better. Take a lot of courses outside of economics, anthropology, history. I'm not a fan of political science, but okay, and sociology, so that you have a broader worldview, and then do pluralistic, interdisciplinary work. Much more interesting work that crosses the disciplines and that takes a variety of approaches, and look for places that encourage that.
Thank you. I was like, I'm going to university next year in Canada. I'm from Canada, and that was one of my main concerns because I knew like there's going to be like a lot of like neoclassical, but I was also kind of looking at University of Ottawa because I know there's a post Mark Lavoie teaches there, so probably like later on, like, but I definitely really appreciate your advice. One question that someone has asked is your opinions on Marxism.
Well, Marx or Marxism. So I think Marx, Veblen, and Keynes are the great economists. Those are the three great economists. And I think they were all working on the same thing. I think they were all developing along the same lines. I think their theories are compatible. Okay, the three great thinkers were trying to understand the same phenomenon, which is what they called a monetary economy. That's what they were studying, monetary economy, and developing a monetary theory of production. All three of those. They had different terms for it. So in Marx, it's called the monetary theory of production. In Veblen, it's called the theory of business enterprise. And Keynes started off calling his the monetary theory of production. He changed it to the general theory of interest, employment, and output. So he can change it to the general theory, okay? But it was along the same lines as Marx and Veblen. So I think those are all consistent, okay? Now, they have different politics, of course. Keynes is trying to save capitalism, reform it, and save it. Marx is trying to overthrow it. So the politics are different. But their view of capitalism was very similar. And Veblen also was trying to reform it, but in a very different way from the way Keynes was trying to reform it. Marxists are a very diverse group. So I think some of them are working in that tradition I'm talking about. And so there's lots of similarities between what they do and what a follower of Keynes would do and a follower of Veblen would do. But then there are a lot of there are some Marxists whose work is actually much more similar to neoclassical than it is to Keynes. Okay, but they call themselves Marxists, and lots of things in between those two. So I couldn't generalize about Marxists. Some of them are very hostile to Keynes and Keynes's theory. Some are hostile to MMT, but some are open. Like Rick Wolff is open. I think he probably thinks we are very politically naive, but he came a couple times to UMKC, and we have talked about MMT, and I know he has given lectures about MMT, and I think that there's a lot of agreement on the theory. His politics are different. So.
Thank you. Another question from the chat was, would you consider yourself like socially progressive or conservative?
Probably radically progressive.
Yeah, I'd consider myself pretty similar as well, but yeah. But I think that's it for the stream. I'd like to thank you for coming on and giving us your time. This was a really productive stream. I think a lot of people enjoyed the insight you were able to give, including myself, especially like your advice for us, as well as answering our questions. So I do really appreciate you giving us your time and coming on the stream. So thank you.
Okay, thanks. Yeah, I wasn't watching the time. I'm a little late for my next meeting, but it'll be all right. But I'm going to quit quickly because I am 7 minutes late.
All right. Thank you so much.
Okay. Thanks. Bye.
Have a great rest of your day.